Welcome to Forex Focus Trading Lab. Today's lesson, we're going to talk about essentials to directional buyers and liquidity in price action. Now, this particular lesson, when you're watching it at first, is going to be so confusing. But this particular lesson is one of the major lessons one has to understand in terms of looking for direction in the marketplace. The moment you are able to get the direction of where the market is going to, you are already in the path of profitability, in the sense that you, as a trader, you want to know with all confidence that price is going to a particular level, and you need to have a narrative in price and have a proper understanding before you engage price. And all of that all put together is called a directional bias. Alright, once again, this is a disclaimer. I'm not a financial advisor. You're here to gain a skill that can change your life as long as you are dedicated and you're ready to put in the work. Now let's move on into price action. When you open your trading view, you're going to be like this. When you go up top left over here, there are some time frames that are there. Okay, when you, some of you may just see just 2 time frames or any of these up here. Mine is the old trading view account. I've been using this account for the past 3 to 4 years, and I've favored so many time frames. When you go there, I want you to look for weekly, the W symbol. Once you click on weekly, when you click on the W symbol, that W symbol means the weekly time frame. The 12M means 12 months time frame. 6M means 6 months, 3 months, monthly, weekly, daily, 8 hours, 4 hours, 3 hours, 2 hours, 1 hour, 45 minutes, 30 minutes, 15 minutes, 5 minutes, 4 minutes, 3 minutes, 1 minute. Now, there are other time frames, but I'm not utilizing them. And again, the fact that I have 1 million time frames up here does not mean I use all of them. I basically use 5 to 6 of them. But on a normal day, I just work with 3 or 2. All of these things, installation will come with time and experience in the marketplace. Okay, now once you click on this W symbol, you're going to have something like this. What that weekly time frame means is that each and every candle you're looking at right here, each and every candle over here, over here, over here, over here, each and every candle is a weekly candle. What that means is this: inside one of all of these candles, there are 5 candles inside, because each of these candles you are seeing over here, when you understand how to read price in terms of the direction, we're going to talk about that in this lesson. You would now understand why it is very important for you to work with your higher time frame, as this particular mentorship is a day trading mentorship. And so we have 2 major higher time frames, the weekly and the daily. These 2 time frames are going to tell us where the market is going to. We need to spend more time in these 2 time frames. These 2 time frames are to tell us we are bullish or bearish. Okay, now when we identify where price is going to on the weekly and on the daily, then we can go over to our 1 hour time frame to check market structure based on the daily and the weekly bias that we understand in price. Now, this particular lesson I'm going to teach you guys today is going to be based off the weekly time frame. We're going to create an understanding on the weekly time frame and how and why it's very important for us as traders to spend more time on the weekly time frame than we going over the lower time frames to look for entries and all that stuff. Okay, now we'll be able to understand where our time frames are being located. This is the weekly time frame on USD card. This is not a pair I trade most of the time, but it is very volatile. Looking at price like this, we have no much information. We basically just looking at candlesticks. But when you go over to your weekly time frame as a day trader, you do not need all of this data to analyze price. You just need a little fraction. Now, just to do you good, you can count the first 60 candles from the current candle that is forming to your left, the first 60 candles, that is what you should work with. That particular sample of data is enough for you. Okay, so let's go deeper in price. This is our framework. Now I want to break this down. Remember, this is a weekly time frame. So we're basically analyzing each and every week. Our focus is to analyze where is the next candle going. What direction is the next candle going? It's not where is the whole move going to. No. Focus on where the next one weekly candle is going to. Now, let us go deep in price and let me explain to you how to understand this. In our previous lesson, we talked about premium and discount. Those lessons you've learned from the foundation class are very, very important, because over here, I'm just going to be talking like you already understand all of this footprint in price. Okay, so if you do not understand those foundation videos, you need to go back and create an understanding with those videos. Okay, now moving on. Identifying our range. In identifying a range, the swing high and the swing low must have taken out a form of liquidity. It's as simple as that. In identifying a swing high and a swing low to form your dealing range, this swing high and swing low must have taken out a form of liquidity. You already know what liquidity is. Looking at this sell side over here, you can see we had some equal lows, and when price took out those equal lows, price did not continue trading lower, but instead it went back into the range. Okay, now watch. Let's go a little bit to our left. Identifying the swing high. If you notice, if you look at your left, it took out a form of buy side, but did not continue trading higher, and instead started trading lower. Okay, now when it was trading lower, after taking out this equal lows, this sell side, what did it do? It refused to trade lower. Automatically, your new daily range will be this high and where this low. Now you ask me, what about this high inside? This is a short-term high, a form of liquidity. And as you can see, when price came down into taking out this sell-side liquidity and showed the willingness to continue trading higher, the moment it traded above this last down close candle, which is a bullish order block, that is when the buy program kicked in. And then when you see something like this, when you see the buy program kick in, your attention will go on to the next buy side liquidity, because automatically price is bullish. And where is the next buy side liquidity? We have these highs up here, one, and again these equal highs. Remember, equal highs are what form of liquidity. Again, price goes for one or two things. It's either it's going for liquidity in the form of buy side and sell side, or it's going to rebalance and imbalance. These imbalance are these fair value gaps over here. As you can see, when price got to these fair value gaps, they were rejections. Now, I didn't mark out all of these fair value gaps because my focus was on the liquidity in price. An old high has been taken, and where was the last time an old low was being taken? Right here. And this was the low that refused to trade lower. So automatically, when price starts trading back into the range, your dealing range starts from this low to this high. Now, when you draw out your fib from this low to this high, you're going to get equilibrium around here. Or when you're using your Gann tool or Gann box, from this low to this high, equilibrium is around here. And remember, we sell at where premium and we buy at where discount. We realized that we started seeing bearishness in price. This other block was holding price, the mean threshold was holding price, and it kept on taking price lower. And then what else did we notice? There was a bearish market structure shift. Immediately your dealing range would switch. This was the last time price had been taken, and this is the current time price is taking out a sell-side liquidity, creating a bearish market structure shift. Now your dealing range becomes this range high to this range low, being a bearish institutional order flow, because right now we have a lower high and a lower low. So what we are expecting in price is a new lower high and then a new lower low. But we observe that price dropped down into a what? A fair value gap, which was at discount from this range low to this range high at a point. Now, it is bouncing off a discount, and what do you do at discount? You buy. For those that would like to like counter trend, you don't. So some traders are unable to follow the trend because they believe it's too fast. So they like to like counter trend in the sense that, take for example, this market is been bearish for weeks. Then they won't sell. They want to wait for price to get to a reference point, and that reference point is this discount fair value gap on the weekly time frame. And then they start to look for something that is against the current trend. In this example, it's a bearish market, but they start to look for something that is against the bearish market, and then they start to buy in this market. All the buys that are happening down here is very, 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 very nice and accurate because they are buying at a discount, taking it back to equilibrium. Now watch. When price got to equilibrium, this is our order block, the mean threshold. You can see that price is unable to close above it. When you see things like that, those are indications in price that, yeah, when price gets to a bearish PDRA and it's refusing to close inside or above that bearish PDRA, that is a sign in price that the bearishness is kicking in. But this is a weekly time frame. We need a lot of evidence. We need close to like 4 weeks or 3 weeks of data for us to arrive at the bearishness in this particular level right here, because we will need another candle to trade below this low. Now remember forms of liquidity: buy side and sell side liquidity, and we said previous week high and previous week low are forms of liquidity, previous day high and previous day's low are forms of liquidity. Now I want you to see something. When price rejected up this discount PDRA, guess what it was doing? It kept on taking out buy side liquidity. When it traded above, it took out this buy side liquidity. Traded above, took out this buy side liquidity, and then we had an inside day. This inside day has a lot of information that is going to be discussed in this particular mentorship. Then the following day, after an inside day, normally after an inside day, we are expecting an explosive day. Price decided to go down and took out all of this sell side. But guess what? It was unable to close below this sell side. What this means is that price has come to run out liquidity. Price would want to buy from a seller and would want to sell from a buyer. You cannot buy a market that you cannot sell to. You cannot buy from a market that you cannot sell from or sell to. So all of these sellers right here, price needs to take them out before going to the buy side and see what happened. When price came down to take out all of these sell side, it kept a what? Equal high up there. Remember guys, these are weekly candles. If we are to go down to our lower time frames, you're going to see a lot of candles inside that particular week. Now watch what happened. Price took out those equal highs and then started trading inside the range again. Hello. Equal lows have been taken out. Buy side liquidity is out. Where will market go to next? Sell side liquidity. It's as simple as that. Now, we are expecting price to become bearish from this particular level. What we want to see now is this: price should start taking out previous week low. Those previous week low are this low, this low, this low. Now our major target is this equal low down here. You see this low right here and this low, they are relatively equal. So when the week starts, this is a weekly time frame analysis. When we go down to our daily time frame, we're going to have a lot of information up here they're going to tell us if actually price would be bearish and if price will want to support the bearishness to take out this low. Once price start taking out all these sell side, we can go down to our lower time frame to get a cleaner and more accurate directional bias to trade. Now this lesson is a lot. This particular lesson is going to take you time to understand because we are basically reading these candles one by one, and our aim as a day trader is to take advantage of just one weekly candle or rather one daily candle. You need to be able to identify where is this candle going to. Is it going up or is it coming down? Now once you have been able to come to a conclusion that it's going either higher or lower, you need to creates a narrative. The narrative here is this: price is bearish. It took out a sell side liquidity. Now it has created a range, a lower high and a lower low. Price is trading back into the range that it has created. From this range high to this range low, at equilibrium, it left equal highs. Those equal highs are suspicious. When price took out those equal highs, these are called buy side liquidity. Because what those equal highs means is this: there are some traders that do support and resistance. They do trade support and resistance, and those equal highs up there means once price gets back to those equal high, it's going to drop down. But what they don't understand is this: once they take a trade at the equal high, they do put their stop loss a little bit above the equal high. And what price wants to do is this: price wants to take out someone else just to benefit another. That's how this game works. And when price got to a bearish order block, we are having a bearish institutional order flow. So what should we be focusing on? The sell side. Price has gone into equilibrium and premium. Equilibrium is around here. When it got to premium, it started retracing back into the range. So what we want to see in price is price should start taking out sell side liquidity. When we go to our daily time frame, we're going to have more details in price. Okay. Thank you so much for listening. Till we meet again, trade safe, trade wisely, and trade only what you understand. Peace.